In this edition of How We Invest Your Money, I'm talking to Kerry from JP Morgan. He's speaking about corporate governance and how within JP Morgan's process, it's nothing new, but the Royal Commission is really putting it in the spotlight for investors and for the industry. He's also speaking about how JP Morgan's global presence feeds into its local operations and how that benefits investors in this region. And lastly, on the global macro scene, one of the things he speaks about is the Italian elections that have just been held.
Well, it's been a growing area of focus for clients for a long time now. You think about the ESG mandate that's coming through and the fact that people do want to see how fund managers are responding to these environmental and social and governance issues. But fundamentally, it's been built into the process for our equity analysts internally for a long time. You know, when they're going through and looking at company ratings, they're thinking about corporate fundamentals, but they're also obviously meeting the boards, meeting the directors, and they'll have their own internal measures to stack up on any red flags that come up on that governance. This is particularly relevant when we think about emerging markets, where obviously, as the head of our emerging markets team thinks about a board, he's trying to figure out if they're lying, cheating, or stealing. So the governance plays a role there, and our analysts actually have a selection of about 70 questions that they'll run through for every company that forms a part of their governance outlook. And based on that, they'll start to uncover some red flags and decide whether those companies should be put in portfolios or should be the ones that are invested in. So it's been something that's happened for a long time, but it's just come to the fore more and more as people think about, negative screening and taking out tobacco and ammunition companies from funds. I think it's going to go deeper than that and actually look at individual companies and how they can add to the ideas about being social or environmentally friendly or indeed have solid governance. Well, I think that's where it comes from, having JP Morgan quite a strong depth of analysts, and they share that information across the network. So it's not separate, say, equity analysts who are looking at their own market. They're looking at it in conjunction. So you might have a sector specialist in the US who is thinking about electric vehicles, for example, but they're then thinking about the components that go into that. So they're talking about the sector specialist and the other analysts who are based in places like Hong Kong, or looking at perhaps where the raw materials for these batteries are coming from, for example. So then we're thinking about our Australian analysts and building into a broader network. And so that's where you get that build-up of a global picture and that drawing on the depth of analyst nature that also allows for that cross-learnings across countries and sectors and building a better picture. And again, adding into that idea about governance and making sure all parts of the supply chain or the company you're looking at actually do have that strength in terms of their governance for their company. Well, there's a lot of things that I think investors are trying to grapple with. They're not really too sure which way to look. If you think about what's happening in the emerging world or Asia Pacific, immediately trade protectionism jumps to mind, strengthening US dollar, which is not traditionally good for trade and emerging markets. And then we also have what's happening in the rates markets, where we've seen 2 and 10-year yields start to move higher. People bringing up questions about how sustainable that is for corporate leverage and lending. For us, a lot of this is just noise. We do think about the trade and the aspects of what you're seeing in terms of US foreign policy on trade negotiations with China, leading to a situation where you're not getting a trade war. I did love the phrase they said they put the trade war on hold. I thought that was a fantastic thing to be able to do. We're just putting that war on hold for a minute. But that's really a signal that neither side wants to have a trade war. They know that there is no winner from having a trade war and they will reach negotiations. Unfortunately, it just simmers away in the background and adds to nerves. The bigger one for us when we're looking at Asia and emerging markets in general is obviously the strength in the US dollar. Start of the year, we thought about a US dollar weakening, a continuing of that trend that we saw in 2017. And, against odds, you've had a very sharp appreciation since the middle of April. For us, again, it's a case of a dollar that's been spiking for unusual reasons. It's not about a US economy that's unilaterally striving ahead in terms of growth. It's the fact you've had the rest of the world looking a little bit weaker. So the Eurozone's been a bit weaker. Japan hasn't really grown in the last couple of quarters. But as that comes back, the US dollar will start to weaken off again. And again, you can see emerging markets perform. We do think trade will rebound and those PMI numbers will come back up, showing that manufacturing is still quite healthy. That adds to the outlook for emerging market Asia, given that it's the supply chain and generally the manufacturing base for most of the world. Outside of that, we're looking at Europe a bit more closely. There is nerves about the Italian political environment, given the outcome of the election and now a new government. But broadly, you're seeing a lot more strength in the Eurozone. We do think inflation will come back at a core level. You are seeing unemployment rate that's still falling, and that's leading to better confidence among spenders. And corporate spending and capex is also rising on the fact that you have a better credit outlook now. A lot of the banks, which were the worry in the past, are fundamentally in a much better position with non-performing loans are lower and higher core tier Tier 1 capital ratios. So we do look at that and say, well, the Eurozone wasn't the favoured market for a while, and it has had patchy performance of late, but we saw a really strong story there as the economy continues to recover. Well, perhaps we think about the US entering in the end of its cycle and moving into late cycle.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.